These are extracts from the recent interview of Rhythm Desai of Morgan Stanley on CNBC. There are a few points worth pondering about to take the right decisions for investing in the Indian equity markets. Foreign investors are waiting for the Indian markets to correct because the market is not correcting and they are waiting on the sidelines to invest. Numbers say that the foreign fund managers are underweight India. Back of the envelope calculations for determining that how much money flow would it take for the foreign fund managers to shift from underweight to overweight India by even 50 bips. Now, this calculation, as per Rhythm Desai, is a staggering 50 billion US dollars of flow into the Indian equity markets. To put this into perspective, the largest inflow in the past, which FIIs have put in a 12-month rolling period, is 30 to 35 billion dollars. And on the other hand, domestic inflows are so huge that the fund managers have to deploy around 100 to 150 million dollars every day in the Indian stock markets to buy Indian equities. Now, if they don't deploy for 10 days, it becomes $1 billion. Another point made by him, SIP money of the Indian retail investor, which has withstood enough events since 2015 and still increasing, has not come to full potential yet. Indian savings, which were otherwise going into property, gold, or fixed deposits, is going into the Indian equity markets. This is very similar to what happened in America in 1980s when 401k pension funds were allowed to invest in the equity markets, and as a result, it resulted into a 20-year bull run. We are in a bubble, but the bubble is not at its end, because even today, after all these investments, only around 5% of the household Indian saving has gone into the Indian equity markets. There is room for this number to go from, say, 5% to 40%. This is the headroom for growth, according to Rhythm Desai of Morgan Stanley, which is another big positive for the Indian equity markets.